Hi, this is Pratik from SAPCHA Enterprises Private Limited. We are a SAP implementation and support consulting company. In our endeavor to provide optimized solution to our clients, we have started training our software specialist in finance management domain. There will be more insightful training material coming in our next series. All the best and enjoy the first introductory training, Finance Management. Welcome all to our first introduction session of Finance Management. This session will provide a brief overview about finance management and its subsequent function. Let's start with what is finance. Although there are various definitions given by stalwarts like R.C. Osborne, Bonneville, Prather, and Wirt, we would like to keep it simple and stick to the below crisp definition of finance, that is, financing consists of raising, providing, managing of all of the money, capital or funds of any kind to be used in connection with a business. Now, what is financial management? Financial management is the efficient and effective planning and controlling of financial resources so as to maximize profitability and ensuring liquidity for an individual, called personal finance. Government, called public finance. And for-profit and non-profit organization, firm, called corporate or managerial finance. Generally, it involves balancing risks and profitability. In order to achieve that, they have to perform three major functions: financing decisions, investment decisions, dividend policy decisions. Now let's understand all three finance functions. Let's start with financial decisions. In simple terms, financial decisions are decisions regarding the process of raising funds. These are crucial decisions made by the finance management relating to the financing mix of an organization. It is concerned with the borrowing and allocation of funds required for the investment decisions. The financing decisions involves two sources from where the funds can be raised, using a company's own money, such as share capital, retained earnings, or borrowing funds from the outside in the form of debenture, loan, bond, etc. Financial management brainstorms and takes financial decisions to suffice below points. Amount of funds to be raised by the organization. External and internal resources involved in raising funds. Legal and security procedures, formalities involved in executing fundraising processes. Tracking the capital market and their changes for understanding long-time raising of funds. Let's go to investment decisions now. In simple terms, investment decisions are decisions regarding the application of funds raised by the organization. It relates to the decision made by the investors or the top-level management with respect to the amount of funds to be deployed in the investment opportunities. The assets in which these funds can be invested are basically of two types: fixed assets, current assets. Let's understand fixed assets first. Fixed assets indicates the infrastructure, facilities and properties required by the organizations. Fixed assets are also termed as long-term assets, and they bring return to the organization over a longer period of time. The investment decisions in these type of assets is technically referred as capital budgeting decisions. Capital budgeting decisions are primarily concerned with methodology to select fixed assets and proposals. Decisions regarding investment in fixed assets during crisis or eventuality. Now let's understand current assets. Current assets are assets which get generated during course of an operation and are capable of getting utilized in short span of 1 year. They are highly liquid in nature. Investments in current assets are called short-term investments and technically referred as working capital decisions. Working capital decisions are primarily concerned with decisions regarding quantifying the requirement of working capital and subsequently investing in it. Analyzing resources available for financing the requirement of working capital. The final decision-making function is dividend policy-making decision. Let's understand what is dividend in simple terms. In case of corporate form of organization, shareholders are the owners and they are entitled to receive the profits in the form of dividends. In dividend policy making, the finance management has to take strategic decision regarding payment of dividend, such that neither the shareholders are offended nor the organization is in a financial problem. Their main focus areas are: disbursement of dividends should be such that neither the shareholders are affected, nor the organization is in a financial problem. Forms or methods in which dividend can be allocated to shareholders. Legal and procedural formalities.
Thanks Pratik for this wonderful overview. This is Alice. I am a finance consultant in the same organization, SAPCHA Enterprises. I would just want to summarize all the points discussed in the previous slides. This is important before we move forward. In simple terms, all the finance functions focus on optimizing companies' assets and capital for its net growth. This net growth can be equated with net profit of the company or the overall shareholder wealth for the company. Generally, the finance functions focus on acquiring sufficient funds, investing them properly, profitability maximization for the organization, maximizing the value of the organization, increasing shareholder wealth. These functions mainly target all the assets connected with the company. They are generally portfolio, savings, currency, balance, money, stock, investment. Finally, everything adds up to a small term called finance. Thanks all, and back to Pratik for discussing further financial management topics.
Thanks Alice for your crisp summary. Now let's understand how goals of finance functions have evolved over the years. This evolution has been a tedious learning step where finance consultants have realized that net profit of the company cannot be the true yardstick for measuring an organization's overall profit value. The criteria for analyzing an organization's success has evolved from net profit of the company to shareholder wealth maximization. In the traditional setup, organization's success was measured in terms of net profit for the company. In the current setup, organization's success is measured in terms of shareholders' wealth now. Let's understand profit maximization concept now. As per profit maximization, all the functions of the business including finance functions will have profit as their main objective. In a traditional setup of profit maximization, all finance decisions are made on the criteria whether the net investment will be profitable or not. A finance management team evaluates all the projects based on the amount of profit each project is making. If a project is making profit, it's straight away picked up. In cases where the company has option of choosing between several profit-making projects, then in such cases projects with maximum amount of profits are picked. If a project is making losses, it's outrightly rejected. In cases where the company has option of choosing between several loss-making projects, then in such cases projects with minimum amount of losses are picked. Let us discuss the drawbacks of profit maximization and the reason behind the overall evolution. The term profit is an ambiguous concept which isn't having any precise connotation. It is very difficult to quantify profit. For example, profits can be short-term or long-term. Profits can be before tax or after tax, and so on. If profit maximization is accepted as the goal, the next question that arises is which type of profits should be maximized? Secondly, profits and risks are never mutually exclusive. The profits always go hand in hand with risks. The more profitable the venture is, the more the risk is. The owners of the business will not like to earn more and more risks by accepting more and more profits. If profit maximization is accepted as the goal of finance function, it totally ignores the risk factor. Thirdly, profit maximization as the goal of finance function totally neglects the time pattern of returns. Earlier returns received will have more value than those received later. The whole concept of planning value and future value is missing in the goal of profit maximization. Last but not the least, profit maximization totally disregards social considerations and obligations to worker interests, society and ethical practices. If these factors are ignored, the organization cannot survive for long. Profit maximization at the cost of these comprises is a short-sighted policy. Finally, profit maximization is based on accounting profits which can be easily manipulated. These accounting profits are not foolproof and can impact the future planning and forecast for an organization. Now let's understand shareholders' wealth maximization goal. As per this financial function goal, all investments, projects would be selected based on the potential growth perspective or net increment in shareholders' wealth. Shareholders' wealth is equivalent to market value of shares plus revenue and surplus plus accumulated profit. In all these variables of shareholders' wealth, market value of shares is the most important factor. Market value of shares is calculated based on number of shares in the market multiplied by market value of each share. If you study this equation carefully, you will observe market value of each share becomes an important criteria. This is exactly the main focus of finance management team as well. The finance management team diligently works towards maintaining the market price for each share and prioritizes all financial functions to ensure its growth. Shareholders keenly observe the market price value for each share. If there is a continuous downward trend in market price, shareholders are liable to sell their shares as well. The selling of shares by the shareholders has a serious negative impact on market price of each share. In continuation with our previous topic, now let's understand net present value method. This method helps in evaluating shareholders' potential wealth forecast and subsequently taking decision whether a particular project should be picked or not. Net present value is a commonly used metric and is based on the time value of money. It works on the principle that future held dollars have less value than currently held dollars. It factors in the time value of money by discounting the future cash inflow with present. Net present value is calculated based on three parameters: present value, future value, rate of interest. If after the final calculation of net present value, if the net present value is greater than 0, the project is picked up. If the net present value is less than 0, the project is rejected. Now let's understand how net present value is calculated. Net present value is based on four parameters: total invested amount, present value, future value, rate of interest. The overall formula for net present value is total present value minus invested value. Let's take a hypothetical scenario. Your company is planning to undertake a project whose initial investment amount is $9,000. The project is expected to have a life of 4 years. Rate of investment from bank is 10%. The expected cash flow at the end of first year is $2,000. Second year is $3,000. Third year is $3,000. Fourth year is $4,000. Let's analyze this on a time scale. Since the initial investment is $9,000, we can take it as minus $9,000 on the time scale. The return expected after 1 year is $2,000. Now this $2,000 is considered as future value since we are going to receive this money in future. Similarly, $3,000, $3,000 and $4,000 are all future values. So on the time scale, please observe the final graph. Now let's tabulate all the values, that is, number of years, invested amount, future value, rate of interest. Now this future value has not discounted the impact of time. This is where the feature of present value comes into picture. Present value is equivalent to future value divided by rate of interest plus 1 raised to power number of years. Now let's see the present value for all future values in the table. Please observe the formula mentioned in the subsequent column. Finally, let's calculate the net present value, that is total present value minus total invested amount. Since the final amount is positive 1,557, we can go ahead with the project. Finally, now let's evaluate the advantages of shareholder wealth maximization method. The concept of profit is systematically quantified in terms of profit incurred by the shareholder. There is no ambiguity in measuring profit in terms of unit. The overall shareholder wealth is directly equated to profit. Secondly, all future and present risks are analyzed before taking any decision. The primary focus is always shareholders' wealth, and all the risks are evaluated based on this parameter. Thirdly, it systematically considers time value of returns. It discounts the future amount value to arrive at a realistic estimate. This helps companies in forecasting and planning and taking calculated risks. Last but not the least, since the prime focus is shareholders' wealth and value, this method has to invariably consider all social responsibility, ethical practices. Lastly, shareholder maximization method is based on optimum utilization of resources. It is based on incoming cash flow. That's all, folks. Please do not forget to like or subscribe our page if you like our presentation. Our future presentations will be more SAP oriented. Thanks for visiting our page. This is Pratik signing off from SAPCHA Enterprises.